Well, the reporting season's just kicked off, but I mean the action's obviously, down the track when we cover, in excess of 50 to 100 stocks. There's a lot to look forward to. The average multiple across the sector is around 16 times, but there's a big divergence that's occurring between industrials and resources. Industrials have seen earnings expectations decline, whereas resources have seen earnings expectations climb. And that's because on the resources side, I guess the low expectations that they're coming off a very low base, and that commodity prices have started bouncing. But it's very much illusory, because obviously with resources companies, commodities prices can fall just as quickly as they climb. So the real focus will be on the industrial companies, and especially on the outlook statements, which I guess is very important for small caps, in particular turnaround stories. Well, there's always more potential in low PE stocks because the difference between a PE re-rating from 8 to 10 is much bigger than a PE re-rating from 18 to 20. And it's much harder, it's much easier to achieve a PE re-rating from 8 to 10 than 18 to 20. So you've got much lower expectations. If they do produce like anything in the way of earnings that are seen as being more consistent and a better, more able to be repeated in the future, then people pay up for that. And whereas that's already predicated in the price of higher multiple companies. So I guess you've got low expectations, and whenever you have lower expectations, that's much easier to outperform. In terms of surprises, there's always going to be surprises at the smaller end because they don't report that much. There's not many analysts that cover them, if any. So there's, I guess, as much interest in their outlooks as in the past, because often the past isn't that big an indicator of the future with these companies, and it's what they say about the future that counts. One company that we've covered for a while now is McPherson's, and that's an example of a turnaround story that just announced their unaudited results on Friday, and the stock moved up 15% on the day, and it's up around 60% since we covered it a year or so ago. They do operate literally under the radar for a long periods of time, and people don't. They just get ahead and do their business, and there isn't the level of scrutiny. And there is constant disclosure, which means they have to advise the market as to whether there'll be much of a differential between what the guidance is and what they actually produce. But there is not much guidance a lot of the time because there's no analysts that cover them, and they haven't been explicit. So there is the potential for them to produce a result that's out of the box. Villaworld's interesting because they're a residential property developer and they're very much exposed to the resources market. When it was well below $2, we really thought, boy, there's some big value here because they can produce good dividends quite easily with their cash flow and their growth. But now the market's starting to anticipate that growth, but arguably things are getting harder because there's a lot of people in the resources industry have been laid off. So when people get laid off, they don't necessarily sell their house straight away. They kind of live in denial for a while, and then 6 months later, it's like a boiling frog, and they think, oh, we've got to get out of the house. So that's a kind of stock where we're going to be really interested to hear what the outlook statement is, and certainly there's much bigger expectations in the stock than even 6 months ago. Companies like CabCharge are going to be very interesting because with all the hype around Uber, we hear a lot of press about it, but actually cab charges earnings have been very resilient. So the market will be looking, and the market started pricing that into the stock. So it'll be interesting to hear what management have to say about whether they can maintain their operating margins. Well, Servcorp was under the radar when we first covered it because it was going through a turnaround. They aggressively expanded into the US just prior to the financial crisis, and they do serviced offices. So, aggressively expanding into a market that got severely hit didn't help because their utilization rates fell through the floor. So basically all these offices weren't being rented out that they had high fixed costs for. But as the US economy improved, the prospects of Servcorp have improved, and certainly the cash flows have improved, and along with it the share price. We look for companies that are exposed to international markets as well as exposed to domestic markets. And there's no doubt that whereas before people were factoring in global growth, people are a lot more nervous about global growth. But I think the thing about small caps is that because they're small, they're actually gaining market share. So they don't have to do that much to, improve their prospects compared to the bigger companies, which are much more reliant upon global growth or upon economic growth for their general earnings growth. The other thing is a while ago, like last year, we were big proponents of gold stocks. Now that some of these, like particularly with Brexit and there's been a ramping up of uncertainty, as you mentioned in your question, there's been a lot more buoyant. The market for gold has been a lot more buoyant. Certainly for gold stocks, which are leveraged play on the gold price, has been buoyant. I guess we've backed off our aggressive kind of stance on gold because there's a lot more frenzied activity in that market. We still advocate to hold gold stocks, but we're certainly taking profits on some of the ones where we've made 3 and 4 times our money.